Hello and welcome to Money News. I'm Kathleen Walter. Joining us today is David McAlvany, the CEO of McAlvany Financial Companies and an expert on the global economy. And David, thanks for joining us today.
Kathleen, good to be back with you.
Well, let's start with India. What are the biggest challenges facing India's economy these days?
You know, with the rupee in steep decline, they have major challenges, and certainly the ones that are growing are of the inflationary kind. Of course, they're wanting to shoot the messenger as gold imports are being limited and as taxes on those products are being increased considerably for both gold and silver. They'd like to say that they're going to solve the problem by limiting the cure. Meanwhile, the problem has been money printing and out of balance, foreign account balances. So it has, at this point, a lot to do with legacy issues, and I don't think they're going to be easily solved. I do think that the new central bank president will bring sort of a breath of fresh air coming from the University of Chicago. And everything that I have read, white papers and research papers that he's put out, he seems to be a very credible guy and an able person for the task, but I think you're still looking at a good 12, 18 months of pain in India.
Now, the Associated Press has reported this week that China's government tried to reassure companies and the public, saying growth there is stabilizing and forecasting 7.5% growth. In your view, is this realistic, and what is needed for the country to maintain robust growth?
I think it's entirely unrealistic. I think we're going to continue to see growth decline. Those growth rates were double digit. They're aiming for 7.5%. Many people that we speak with in the university system there in China suggest that it's already between 5 and 6% and will ultimately settle into a 3 to 4% growth range on a longer term basis. Mm-hmm. You can't have high growth rates and sort of normal and healthy investment. What you have today is malinvestment. That is what gave us the high growth rates, and they're trying to wean themselves off of a very unhealthy dependence on state investment in infrastructure. And that's going to be something that will take the growth rate down naturally, and I think that's actually quite healthy. It's not a bad trend to move towards a long-term sustainable growth rate as to one that's instead of one that's artificially propped up by the government and government spending.
And what level of growth can we expect from emerging markets in general, and what are the greatest challenges that they're facing?
Yeah, I think of the emerging markets as being the beneficiary of capital flows from the developed markets, and to the degree that you have dysfunction in the developed markets, on a lagging basis, you'll have that same dysfunction in the emerging markets. So the argument is made today that emerging markets are much more attractive from a valuation standpoint than your developed markets, and I would agree if you're looking at those numbers. But the return to a healthy business cycle is still going to be dependent on health in the developed world. The emerging markets have not emerged, so to say. They've made great progress, and they certainly have more pristine balance sheets than we do in the West, specifically in the U.S. and Europe. But that is to say, they are still dependent on cash flow. Just because they have a healthy balance sheet doesn't mean they are independent from the West in terms of cash flow.
So where can investors find the best opportunities?
Well, I think from a long-term basis, you will see some values in emerging markets, and I think you'll see some values in the U.S. markets as well. We aren't at those levels yet. In fact, if you're looking at the U.S. markets today, I think you may have relative safety there compared to the emerging markets. You could continue to have more downside volatility in the emerging markets than in the developed world, but I still think you could give up 20 to 30% in the Dow and the S&P here shortly. That's in part because we're looking at a cyclically adjusted price-earnings multiple of close to 25. That's pretty high. If you're looking at a normal PE, 18, 19, again, you're not in the nosebleed section, but you're certainly not buying a value today. And you'd have to argue, if you're stepping into the market today and putting money to work, you still are operating on the greater fool theory. You're hoping someone else will come in and pay an even higher price than you did.
So will the Fed begin next month tapering quantitative easing? And if so, by how much will the Fed taper? And if not, when will the taper begin?
Kathleen, the taper is unlikely to occur in part because of the consequences of tapering. If you take away the punch bowl, so to say, as William McChesney Martin suggested, that was the role, and he was Fed chief from 50 to 70. If you took away the punch bowl, at this point you would see major impact in the stock market, negative impact. Again, it might even be 30% on the downside or 40% on the downside. if you were to really tighten things considerably. You would have a major impact on the bond market. We've already seen a foreshadowing of that with rates jumping considerably. Consider this. If the gold market was to reflect the kind of move that we just saw in the bond market, gold would be trading at about $2,300, $2,400 today. Okay, that's the kind of massive volatility we've just seen in the interest rate market, and this is just with the suggestion of tape. If they actually take away the punch bowl, what are the real consequences? Lastly, the third market that I think is very important is real estate. Real estate would take a significant hit, in part because financing charges would go up. You'd have your mortgage rates back towards your 5.5%, 6% range, and your marginal buyer would be squeezed out of the market. Volumes are not great, and I think they would get much worse if they weren't tapered. So all those things argue against any significant tapering or tightening at this point.
And what about oil? Will we see a fear bid in the price of oil, or are we already experiencing it as a result of the events taking place in the Middle East? Can we expect the news from Syria to contribute to this, and what are your price predictions?
Sure. Well, on the basis of supply and demand, oil right now should be below $85. The fact that it's trading between 110 and 115, there is a fear bid in the market. This is not basis supply and demand. This is definitely on the basis of concerns in the Middle East. And boy, are there reasons to be concerned. We've had issues in Syria for over a year, and they're getting worse. We've had issues in Egypt, and they're getting at least more confusing, if not worse. And we still have issues in Turkey. So the area, and of course Iran. So, I mean, 4 areas in the Middle East, not all of them critical to the supply, but some just critical to the supply chain, the delivery and transmission of oil to Europe and to the United States are in jeopardy. So the destabilization has brought oil prices this high. I think if there is a conflict in Syria where we initiate something, the British initiate something, the French initiate something, any country that does, if they do, then I think we're looking at a very unstable environment in the Middle East, far more unstable than what we have today. Keep in mind, you're dealing with state actors today. You'd be moving to a negotiating table and trying to create a government with non-state actors tomorrow. What kind of instability does that bring to the oil market? I think considerable. So I don't like the Assad regime, but better the devil you know, perhaps, than the devil you don't.
And what about your view on inflation? What can we expect here?
I think inflation over the next 24 months will be considerable. We would agree with the likes of John Williams that inflation is already understated considerably. And so when you look at our GDP statistics, they're not as rosy as they appear to be. The deflator, which is the inflation component in the GDP statistic, is massaged lower, just as the CPI, the official consumer price index, the measure for inflation, has also been massaged lower. And so we probably are in a 5 to 10% range, not the 2% spoken of, but that 5 to 10% range could become more aggressive in the weeks and years ahead, months and years ahead. And we would expect that awareness of inflation to enter the mind of investors here in the United States, as it already has in the rest of the world.
Is there any hope that U.S. workers will receive in either the long or short term any boost in wages adjusted for inflation at any point in the future? I mean, if so, when? What would be needed to make this happen?
No. In a word, no. I mean, when you look at what's just happened in Japan, I think you have a decent proxy. The government was assuming that business leaders would play ball, and in this effort to reflate the economy, print yen like mad, and boost via monetary stimulus, the assumption was by the government that corporations would raise wages so that there wouldn't be a squeeze, an inflationary squeeze. And corporations have said, no, we're going to protect our margins. We care more about our margins than our people, to be quite frank. And that, I think, will be the case as in terms of universal sentiment, defending margins as opposed to taking care of workers. So no, I don't see wage inflation. So that leaves us with a scenario that's very much an echo of the 1970s, stagflationary, rising prices and stagnant wages.
And last question for you, David. What can we expect in the municipal bond market as developments unfold in Detroit's bankruptcy. And regarding the price of gold, will physical demand in Asia be outweighed by any tapering of quantitative easing?
Well, first, on the municipal side, the biggest threat to the municipal market is a precedent being set where general obligation bonds are not a first priority, but are somehow second, third, fourth, fifth in line. What has been suggested in the bankruptcy court is that GO bondholders get paid 20 cents on the dollar. That would be unprecedented, and that would be a game changer for the entire municipal market, adding a tremendous amount of insecurity across the country amongst general bond obligation owners, bond owners. Gold will continue to see high demand in Asia because, again, we have global inflation and we have ways of covering that up here in the West to make it appear that there really isn't much inflation to speak of. But you take India as an example. They're raising taxes on the import of gold. They're limiting the imports, the total tonnage coming in, and yet inflation is running at 10%. That's the official rate, 9.4, the official rate of inflation, and their currency has just dropped to a new low relative to the US dollar, a new all-time low. This is massively inflationary, and you're talking about a culture that on average lives on less than $2 a day. So a little bit of inflation really hurts. This is common throughout Asia, and I think you'll continue to see demand for gold as an antidote to inflation continue. So the supply-demand fundamentals are very powerful for gold, and we would continue to expect gold to be, in the next 3 years, in a range of $2,500 to $4,500 an ounce.
All right, David McAlvany, thanks for being with us today.
Anytime, Kathleen.
And thank you for watching Money News.